Good afternoon all. Today I am going to discuss the topic RBI surprise rate cut and its impact on bond market. We all are aware of that the RBI has taken the markets by surprise by cutting 50 basis points repo rate cut, which is a humongous step which it has never done before. A 50 basis points rate cut means the lending rate and borrowing rate are becoming cheaper. The borrowing rate and deposit rates. This move has taken the markets by surprise, since most of them they were expected only 25 basis points rate cut. But why the RBI has cut 50 points? And the main thing is in this video how it will impact the bond market. We must understand that the money market and the capital markets will go hand in hand. Doesn't ring a bell, right? I will explain you. We have two markets, money market and capital market. Money market, which is controlled by the Reserve Bank of India, and capital market by SEBI. These two markets, what is the purpose of the market? By using these two markets, these institutions or investors, entities will raise money. The instruments used in money market we call money market instruments. What are they? Certificate of deposits, commercial paper, treasury bill, and repo rate, and so on. By using these instruments, entities will borrow money from the investors or the public. And second one is capital market, which is regulated by the SEBI, Security Exchange Board of India, for the record. And what are the instruments? Bonds, equities, and debentures. In this video, I am going to focus on the rate cut of repo rate and its impact on bonds. We will discuss the later things in some other video. So, how the repo rate will impact the bond market. This is a very interesting topic. In books, you will not find these concepts in detail. So, I request you to focus on the video. Without wasting much time, let's dive into the topic. Before we delve into the topic, we must build a basic understanding with respect to what is a bond and its key feature. Let's start with the definition of bond. What is a bond? So, don't get shocked by seeing the definition. So, this is the definition of bond, right? A bond is a debt security which has face value and fixed coupon rate issued by either the government of India or private entity, and to raise the funds to fund their expenditure with a predetermined maturity date. This is what we call bond. Sounds all Greek, right? Let me explain you in layman language. Bond is nothing but a promissory note. So you all are heard of promising note, right? So it's just a promissory note that is issued by the government of India with a face value of 100 rupees, see, with a face value and rate of interest and maturity period 5 years. So this is the bond. It's just like a promissory note. The reason why I have taken the multiples of 10 because it is for easy calculation. In reality, the figures are very humongous. It is normally in 1 lakh denominations. Right? So it's simply bond is a government security or government promissory note issued to the investors, and it will raise money from the investors to fund its expenditure. What kind of expenditure? Either revenue expenditure or capital expenditure. And the corporate companies also will do the same. We call them as corporate bonds. But in this video, we are going to focus on government securities. If you read the definition of bond, nowhere in the definition it has mentioned that the bond is backed by an asset. Nowhere in the definition. Yes, you heard it right. A bond is not backed by any asset like gold, silver or any international accepted asset. Then how a bond derives its value? A bond derives its value from the people's trust on the government. Yes, you heard it right. A bond will derive its value from the people trust on the government and the creditworthiness of the government. Creditworthiness will build on the prompt repayment of a debt, right? Just like credit card, like CIBIL score, right? If you pay it on time, what will happen? Your credibility will increase. So, in the same way, a bond also derives its value from the government assurance, because people believe that their government is not going to default on what it borrows. This is how a government bond will work. We also call it as government security. So, now that we understand the definition of bond and its key features like face value, maturity date and coupon date, let's delve into our main topic. What is our main topic? First, we'll take a template of bond. I already told you it's like a promissory note which has the face value and coupon rate and maturity date. Suppose 5 years face value. And coupon rate, hypothetically think that the rate of interest, the rate of interest we call coupon rate. Okay, this is the bond and the government has issued this bond. Government of India issued this bond. Now, I am a person, I am an investor, I am a public who has deep pockets and I have money in my pocket. I want to invest my money somewhere else, right? So, I prefer bond, government bond, and I bought the government bond. Me, like Karthik, I bought the bond. So, I hope that I bought it for 100 rupees of face value and with 10% rate of interest, and this interest is paid semi-annually. What does it mean? For every 6 months I will get my interest. What is the interest? 10% of the 100 means 10 rupees. So, for every 6 months I will get 5 rupees of interest. Did you get my point? It is as simple as that. So, everything is going simple, but we must strike the relation between the money market and the bond market. What RBI has done? RBI has cut a staggering 50 basis points repo rate cut, right? Repo rate cut. See, whenever the RBI cuts the repo rate or interest rates, it will impact two rate of interest. One, borrowing rate and deposit rate. See, most of the people thinks that when the RBI cut the repo rate, we will get benefit. Yes, we will get benefit. We will get benefit on home loans, car loans, personal loans, education loans. But there are people who saves their money in the banks in the form of fixed deposit, recurring deposit, and apart from banks, national savings certificate and money market instruments, as I said before, commercial paper, certificate of deposits, etc. These people will lose money, right? Take the example. I am taking the example hypothetically SBI, right? Before the rate cut, SBI is offering the fixed deposit rate of 10%. Everything is fine, right? The SBI is offering 10% of rate of interest on FD and the bond is also offering 10% rate of interest on the bond. Everything is going fine. But after the RBI's repo rate cut, the FD rate has become 9.5%. Why? Bond, excuse me. What is the reason? It will impact not only the borrowing rate but also deposit rate. So, the fixed deposit has become 9.5%. But what is with the case of bond? So I particularly emphasize on certain word, fixed coupon rate. Bond is something which will offer you fixed rate of interest. So bond rate of interest will remain fixed 10%. Fixed deposit rate of interest reduced to 9.5%. You may wonder now, it's just 0.5%, right? No, it's a very big amount. When you are investing crores, hundreds, and I mean 100 crores, 1000 crores of money, 0.5% deviation will result in a staggering loss. So that is why for investors who has deep pockets, even 0.1% also it matters for them. So don't look down on these numbers. And what has happened? These investors with deep pockets, they realize that the money market is not offering them a lucrative return. Then what is the alternative? Immediately they will turn to bond market. So what will happen? These investors with deep pockets, not people like you and me. So investors like deep pockets, they will chase the bonds to buy. They will chase the bonds. What will happen? It will pent up the demand for bonds. It will pent up the demand for bond. But the supply remains same, right? It's just because the demand has increased, it doesn't mean the supply is also going to increase proportionally. The supply will remain same, but due to this investors demand, this investors risk appetite or their profit making, it will pent up the demand for bonds. So what will happen? I request you to keep this picture in mind. Before that, I will write an ideal case. First, rate of interest is 10%, right? And the face value is 100 rupees. And what is the coupon rate? 10%. Simple math, no rocket science. Then what has happened? Once the RBI has cut the rates, there is a increase in demand for bonds, and the investors started chasing the bonds. And me holding a bond. Karthik, I am holding a bond. And an investor come to me, he wants to buy my bond, right? 5 years. By seeing this opportunity, what I have done? Yes, I will sell the bond, but not for the face value. At premium rate, I will sell. What does the word mean, premium? Premium means I would like to sell my bond above the face value, right? Above the face value. Because I want to encash this opportunity. I am a current bond holder. Here, bond means the bond that is already issued in the market and trading in the market, not the new bonds. Okay, please remember this. And I just want to encash this opportunity. I just want to encash this demand so that I increase the face value from 100 rupees to 110 rupees. And I told that investor, if you pay me 110 rupees, then only I will sell my bond. Right? Did you get my point? Then that investor said, okay, fine. Even for 10 rupees premium, it's okay for me. He bought the bond from me. But if you run the simple math, what will happen? 10, the coupon rate is fixed. Face value instead of 100, now it has increased to 110. And if you calculate the percentage, what has happened? What is the number? 9.09%. From 10% standard to it decreased to 9.09%. Means there is a decrease in yield. This is case 1. Who will benefit from here? Me. Me means current bond holder, right? I am happy because my face value is 100 rupees and I sold it for 110 rupees. And who will be at disadvantage side? The new buyer, right? He is not happy. Why? Because the face value is 100 rupees. I sold it for that guy 110 rupees. Eventually, we must focus on the yield value. And case 2, What is case 2? What if exactly opposite happens? What if the bond rate is 10%, but repo, RBI has increased the repo, increase in repo reflects on fixed deposits. Now the SBI is offering the fixed deposit of 10.5%. Okay. And these investors, believe me, they have a huge pile of cash. Especially these foreign institutional investors, they collect money from the public and they are sitting on a huge pile of cash. They want to generate more returns on their investment. That is their main thumb rule. So by seeing that 0.5% hike in FD interest rates, what they will do? They will immediately shift their money from bonds to money market instruments. What is going to happen here? Bonds are in less demand, right? Bonds are in less demand. You may wonder, sir, why these people are doing? That is how they will operate. The BlackRock, JP Morgan, Morgan Stanley, that is how they will operate. Private equity funds, hedge funds, they always look for the return on investment, ROI, return on investment. So the same thing what will happen when there is no demand or means low demand for the bond, no one will come to buy my bond, right? So in case 2, I was compelled to sell my bond at discount price. What is the discount? Any value less than the face value, we call it as discount. So I was compelled to sell it at discount price. Instead of 100 rupees, in case 2, I am selling it on for 90 rupees. If you calculate the percentage, it will turn around 11.11%. If I am not wrong, correct me if I am wrong. So what will happen to the yield? Yield increased. So we have two scenarios here. First, ideal scenario, 10%. When there is a rate cut by RBI, yield has increased to 9.09%, yield has decreased to 9.09%. When there is a rate increased by RBI, yield has increased to 11.1%. This is the simple relation. Just because the yield has decreased means don't think we are getting more return. Just because the yield is increasing, it doesn't mean that person is getting more return, right? Try to understand the logic. These are the simple math. Whenever case 1, whenever the RBI cut repo, it will pent up the demand for bonds, right? Once there is a pent up demand for bonds, what will happen? Bond face value will increase. I am selling at a premium price. Once the face value increase, what will happen? Numerator by denominator, simple elementary math. The face value will increase by 10% or 10 rupees. This is just an example. Whenever there is an increase in demand, increase in denominator, what will happen? The end value will decrease. Simple math. Increase in denominator value results in decrease in final value. And same number case 2. What if RBI increase the repo? Increase in repo results, increase in FD. Increase in FD results, less demand for bonds. Less demand for bonds results selling at less face value, discount. So simple, numerator by denominator. What will happen? Face value will decrease. Decrease in the denominator will increase the final value. Simple math. If you substitute the 10 or 10 and 100, you will get the basic idea, or you will get the clear picture. So whenever you are confused, the examiner may trick you. What happened when the face value increase? What happened to the yield? What happens when the face value decrease? What happened to the bond yield. This is the basic simple formula question. It's not a rocket science, it's not a complex math. Just try to remember this. So fine, bondholder me and new buyer, we are sometimes I am happy, sometimes he is happy. What about the government of India? Do you think the government of India just a spectator here? No. The government of India, curiously, they are very actively follows this yield change. Why? Government of India always hope for the case one. Okay, it wants its face value to increase. Excuse me. The government of India wants its bonds face value to increase. Why? The reason is, if the government of India wants to issue new bonds, it can offer low coupon rate. Instead of 10, now it can offer 9.5%. Why? Because in the money market, they are also offering 9.5%, right? The new bonds, those are going to issued by the government of India will follow the money market rate of interest. It will be based on the money market interest rate. So that is why it is very helpful for government of India if the face value of the bond increased. The new bonds that are going to issued by the government of India will offer a low coupon rate. Low coupon rate means low debt on government of India, right? Government is getting funds at a cheaper rate. So that is why government of India always hopes for the low yield, not high yield. Please don't get confused. Low yield. Low yield is always good for the government of India. Why? Low yield means high face value. The bond is deriving more face value than it is issued at the time of So now that you understand what is a bond, what are the futures, how the RBI rate cut will impact the bond and current bond holder and the new buyer and the government of India, I would like you to understand what are the repercussions, fallouts. What are the fallouts or disadvantages? Government of India is happy, right? Now, why? Because the new bonds will be available at 9.5% rate of interest, right? And new buyer is also happy because he is getting the bond at low face value, discounted face value. But what about the foreign investors? Foreign investments. I already told you these big entities, BlackRock, JP Morgan, Morgan Stanley, and you name it, they buy it. Private equity funds, they will invest in Indian government securities. Why? Because on developed nations, the return on the investment, the coupon rate on their bonds is very low. Yes, you heard it right. Just because they are developed nations, it doesn't mean they are offering high rate of interest. No. Developed countries, US and Euro, they will offer very low coupon rate. Low coupon rate on their bonds. So that is why even though they have huge pile of cash, people has the money, investment funds has the money, but they are reluctant to invest in their own country's bonds because return on investment is very low. That is why they proactively look for the emerging nations such as India, China and other nations, those countries, which countries offer high rate of interest on the bonds. But what's happening here? What's happening here? The yield is decreasing. Return on interest is decreasing, right? When the return on investment is decreasing. When the return on investment is decreasing, these investors, foreign institutional investors, what will they do? They will not interest in our GSEC bonds. You may wonder that, sir, at least we are offering 6.5 to 7%, but in US Treasury bonds, federal bonds, they are offering just around 3.5 to 4%. But here is the catch. So whenever the foreign investors, they are investing in India or any other countries, they will face exchange risk, currency exchange risk. Hypothetically speaking, the yield difference between US federal bonds and India is 2%. Even though it is 2% profitable for the foreign institutions, but our currency rupee depreciation will erode this profit. ఈ 2% margin కూడా ఉండదు. Sorry for the bilingual. So this 2% return also will get eroded by the currency exchange risk. That is why it is very important for the government or any country must ensure the return on the bonds rate, coupon rate on bond should be lucrative. Because you all know India is a developing country, we are in a dire need for foreign funds. Yes, we have domestic funds, banks and everything, but to improve the technology, to make advancement in technology, and foreign investments are debt free in nature, right? So that is why we must attract the foreign investors. If we want to attract the foreign investors, we must ensure our coupon rate shouldn't fall very little, very less. It should be attractive. I hope you understand this concept. This is a bit complex and tricky concept. Yes, I can understand it, but by subtract, I have taken some simple numbers to explain to you in a layman language. I hope you like the video. If you found this video informative, please like, subscribe and share this video. And there is one small concept called bond yield curves are there. Bond yield curves. If you want me to explain this concept, comment below. I will try to explain. I will make a new video on this concept. So already the video has already 20 minutes duration. If comment below, if you want, I will make a new video on the bond yield curves. Thank you for watching. See you next time.